Welcome to All Things Flamingo Podcast with the Flamingo Group and myself, Beth Reilly. Join us as we discuss all things to do with our community, real estate, and all things Flamingo. Welcome and tune in for a flocking good time. Well, hello. My name is Beth Reilly, and today I have the privilege of interviewing two people. One, of course, is Dan Burling, who is my coworker and my husband. So thank you for coming on today. Mm-hmm. And then also Bob Lunan. Bob Lunan is from Lunan and Lunan Consulting. He's had over 38 years of professional education classes for actually insurance agents. And now it's going into also working with realtors and educating us to all the different ins and outs of insurance, along with our topic of the day, all about condos and HOAs. So thank you so much for coming today.
Thank you for having me.
It's a privilege. So I guess we'll just start out with, could you tell me a little bit about your consulting and how you got into it, and just kind of roll into how we came to this decision that you'd be the best person for this podcast?
So back in the mid-1980s, I started teaching professional education classes, and some of them were licensing classes. And I was instructed that there was test world and real world, and that you teach towards the test world. And I'm thinking, well, no, all of those test concepts are based on something real world. So I spent 3 years researching what's the connection, and was able to make many of those connections. And then went along, was in business at an insurance agency for 40 years. I'm a former state legislator, and that's where I discovered that in Minnesota, state law requires that associations insure the buildings, the structures. It would be so much more cost effective if that was not the case. And I'm hoping to work with legislators this upcoming year to see if we can remedy that. But it's the insurance cost on it is getting to the point where it's prohibitive.
Right. Absolutely. So when you started to get involved with this, Dan, if you could take it from here, we ran into something with a condo.
Yep. So the conversation was, we have someone that has a condo, and they're looking at selling, want to get into a single family home, and then they had heard through maybe a lender that there was some restrictions on some of the lending options that are available, primarily the conventional, that if the HOA document and some of the things you're talking about, Bob, are referencing primarily the deductible. If the deductible is set too high, it might prohibit people from being able to sell their condo, and lenders may not jump in on it. So it got us starting to look at it, because from my conversations with a couple people, this is a situation that was just starting to evolve. And I think it got to your point, Bob. And I call Bob whenever I panic, because I met you, I bet 30 years ago. And you're very good at explaining it always and dialing it back. And this is going to be, like we talked about, this is going to be a conversation that I think is going to be extremely helpful, because this is a topic that's just kind of emerging right now. And the question is, hey, I want to sell my condo or townhome. Am I being restricted on who can buy it? I mean, is it only good? I heard a couple people saying, hey, I can only sell it for cash. And it's like, no, there's got to be lending options. And so we discovered what the problem was. I called Bob up and got a hold of some documents for him to interpret. And that's kind of what got us to this point. So, I don't know if it's best, Bob, just to go ahead and kind of go into that topic, or talk about maybe in general condos and townhomes and some of the documents that are involved with and how they work, maybe from a basic standpoint, and then we can go into the issue.
Well, Dan, let me do a flyover really quick. That the what you brought to me on that case, and I remember it. By the way, I also remember we met. You were in one of the classes I was teaching way back when.
Yep.
And what happened is that the the association, I'm going to call it an HOA, the Homeowners Association, has a policy. They are required by law to cover the envelope of the building, which is the roof, the walls, the windows, things like that. And inside of the unit is the responsibility of the unit owner. Well, the association buys what I am going to call the master policy. In my world of insurance, it's really called a business owner's policy, or a BOP policy. So you've got the BOP policy over here, and then you've got the individual condo policy, which in my world is called an HO6 policy. All claims, and this is important, first square to understand, all claims go to the master policy first. And here's why. All homeowners, including renter policies, condo policies, homeowners policies, all homeowners policies have an exclusion that states that if this claim can be or is covered under another policy, we don't cover it. So boom, it kicks it right to the master policy. They go first. And they take the lion's share of it. It's a lot like Medicare and then a Medicare supplement. Then what happens is that the responsibilities of what the HOA is supposed to insure and not supposed to insure are all spelled out in the governing documents. And I'm not going to go way into the weeds on those. That's a whole world in itself, but I'll touch on what I know is important, directly important. And it will spell out, it will define what the association considers building. Is it the structure and anything attached to it? Is it the structure as it existed when it was first built? In other words, we don't cover betterments. Is it the structure from the studs out? So they're minimizing what the association is going to cover, which pushes a lot of responsibility to the unit owner. All right. So it goes through that first filter, then it gets passed over to the unit owner. And the unit owner has what I said earlier was an HO6 policy. And there are two very important property coverages to understand. The first coverage is on the front page of the policy that everybody reads, called the deck page, called coverage A, which is your building coverage. Coverage A on an HO6 policy only covers that part of the structure that is solely owned by the unit owner. That doesn't include the roof. That doesn't include the exterior walls. It's the kitchen fire. It's the bursting pipe where you have water damage. That's what that coverage A covers.
Okay.
Right?
Yep.
But to keep this in context, Dan, the governing documents typically say the association will step in on all claims involving the association directly right away. All right. And it still goes through that filter. However, there's a second coverage on an HO6 policy that's buried inside of it called assessment coverage. And the assessment coverage automatically comes with a limit of $1,000. You can increase that, and it is very cost effective to do that. Well, what that covers is, so the association has a $25,000 deductible and a 10% wind and hail deductible. You have a $300,000 condo. If you have hail damage to the roof of that condo, there's a $30,000 deductible there that's going to get assessed to that unit owner. You need to get your assessment coverage above a figure greater than what that deductible is. And as a for instance, I just looked at ours the other day, to go from a $1,000 limit up to a $50,000 limit for assessment coverage is $18 a year.
Oh,
so you got to know about it though.
Yeah. And that's where the big gap is, isn't it? Is the awareness? The
awareness. Yep. And people who are, now we're seeing situations where more and more where lenders pull in these, I'm going to call them 1-800 carriers, and they just aren't built to give that information out to people. It's all kind of checklists. And so the people that are working without an agent, boy, they've got to do their due diligence. And that's where the importance of a realtor is critical here, because you have so much more experience than that unit buyer, that condo buyer. And hopefully your client can take advantage of that, of going to bump that up and understanding why.
Yep. Hey, could you give an example? I think you were telling me about, and this would be helpful, I think, an example of someone who wasn't covered and how they've all of a sudden faced, I think you were aware of somebody that didn't have the proper coverage, and all of a sudden now they're going to either lose their condo.
So what happens is that the policy comes with $1,000 deductible or $1,000 of coverage.
Yep.
So someone who's buying on their own and filling out a checkbox, obviously they want to keep any costs down they can.
Yep.
They don't understand. So they go through and they buy that $1,000 of coverage. We've had several dozen people we've worked with, not in our agency, but other insurance agents that I work with because I teach them, where these people have gotten assessments for $18,000, $25,000, saw one for $41,000. It was $410,000 condo. and and it was a young couple with little kids, and they're just getting handed a bill for 41 grand, and they've got $1,000 coverage for it. That's traumatic.
Yeah.
What causes this is people being people. The board goes through and sees this big premium increase and knows fully well they're going to have upset members. So we've got to do what we can to try to mitigate or reduce that hit we're going to take. So they take a look at higher deductible options, and then they find one that makes the most sense. It won't be happy. It will be the happiest. Okay. Mm-hmm. And then what they do is they typically work with the insurance agent on the HOA, and they send out a letter to each unit owner. Well, that letter is going to come on insurance company letterhead and insurance company envelope. Well, I think a lot of people heat with wood because I think I know where that letter goes right away. They just burn it. It's gone. Okay. Yeah, and they don't read it. They just think it's advertising.
Right.
I get that. Okay. That's why, again, the importance of a realtor going, hey, this is something you want to keep an eye on and take a look at. Okay. So what happens is they get this sent out to them and they don't do it. And so now all of a sudden, now you have the storm claim and it's too late. The claim has occurred. You have to live with the coverage you bought. You gotta put that pair of pants on whether they fit you or not and walk around.
Well, is this for all states like Minnesota, Wisconsin, North Dakota? Okay.
So real estate or I think is regulated also on the state level, but so is insurance. So and I'll just give you a very understandable difference. In Wisconsin, if you have a tornado claim, they're going to surcharge you for that as if you had any negligence at all in causing that. In Minnesota, we go, well, there's nothing you can do about having a tornado. The carriers are not allowed to underwrite or raise your premium for that other than the losses they incur. Okay. So every state is different, Beth, and in mostly subtle ways. The similarity is there's an incredible overlap. And we do insurance classes throughout the country, and we try to pick up, those differences so that we understand them, so we can just answer questions that we have. And then you go through and again, that statute that requires the common interest community. It's statute 515, by the way. That's where it's all at. Not that I noticed neither one of you wrote that. Oh, Beth's writing it down. It's going to be a test. Yep. But a lot of these things are spelt out there. And there's some very important things in there. First of all, there are no qualifications to being on a HOA board.
Right.
In fact, usually you're the person that skipped the meeting, and so they elected you.
Interesting.
Now you got, okay. Yep. Or worse yet, it's someone who really, really wants to be on the board. They concern me even more.
Yeah. Okay? Yeah.
So they go through and are qualified, sometimes not qualified. And that's another important thing for realtors. You don't, and I'm not going after anybody, I'm just stating a fact. Don't assume that the HOA board is qualified to make the decisions they're making. They're just doing the best they can. That's just a reality. Yep. Okay?
And from our conversations, realtors and insurance agents are going to have to be a lot more spot on this stuff, paying attention.
I actually look at it this way, Dan. I think this is an incredible opportunity for a realtor to add service.
Nice.
Incredible opportunity. We've got these, these young people coming in, these millennials that, think they can do everything online, that the phone is everything. And then they find out after the fact, oh, the phone isn't everything. And I only made decisions that were as good as decisions I can make based on what I know. And it's like taking your car to the mechanic and asking to borrow the mechanic's tool so you can fix your own car.
Yep.
That. You're talking to somebody that knows things you don't. And part of the excitement of this podcast is I want to get the information out there so that product, that insurance information, is being distributed by realtors out there just to help the consumers.
Yep. So I'm going to give you another example that I came across, a real life example from another agent that we know. She was representing a condo over in Woodbury and had a buyer come in, make an offer, and most loans, conventional loans, go through Freddie Mac and Fannie Mae.
Correct.
And Fannie Mae has a restriction that they cannot underwrite a loan if the deductible in the HOA is greater than 5%. So this particular one had a deductible at 8%. And because of that, nobody intervened and said anything about increasing the HO6 or anything like that. They just came in and denied the purchase. And so everybody just walked away apparently from that one.
Yep.
What you're saying is, okay, if the document says 8% and Fannie Mae is coming in, I've talked to lenders that are saying that if you can come in and explain how the HO6 is going to make up the difference, that is where, we can get these loans and people can have a conventional loan. Am I following that correctly?
Yeah, but you have an important aspect out there. There are people walking around that are called underwriters.
Okay.
And they go through and they are the Department of No. Okay. So they'll go through and they just stop stuff. And you may not be talking to the person. Certainly the mortgage sales rep won't be the person that yeses and nos things. Okay. But educating them about it. There's actually two ways to clean that fish. Okay. You can go through and correct the HO8, the HO6 and present that documentation, hoping that you get an underwriter that can follow on it. You get it, which would be likely, very likely. Or you turn around and you educate the board about it and saying a 8% deductible isn't going to work. We have to drop it down to a 5% deductible, which is going to increase our premium. But in a lot of ways, it increases the value of each unit at the time of sale because you've got a broader market to sell to.
Excellent.
And that's, again, where the value of a realtor, you're right there at that pinch point when that decision is being made, and a mortgage lender too.
Is this something, is it because of, all the experience you were talking about, how claims are going up so dramatically? Has this thing just emerged recently as an issue?
It has emerged recently, and there's a couple of valid and a couple of nefarious reasons for this. All right. So 2022 had all these storm claims. And what we discovered, we're doing a continuing ed class on how to read HOA documents. We're doing another class on contractual transfer of risk, just on contract. Well, what we found out is it is more common than not that when an HOA has a property management company, that contract, which nobody reads down towards the bottom, says the board will allow, in the event of an insurance claim, that's important, the board will allow the contractor to hire the property manager to help with the claim. Well, let me tell you what that is. The property manager is going to bring a contractor in. And well, I'd like to do a podcast sometime on bringing in competitive pricing back in, but that's not going on right now. So the insurance companies are setting the number of what the claim is going to get paid at because people aren't going out and getting bids.
Only one price.
What's that?
Only one price is given instead of three, usually.
Yep. Okay. Well, the way we Irish word it, Beth, is there's only one guy in the bar, so I don't have to keep, I don't have to take care of myself that much.
Yeah.
I'm the best looking one, the nicest, and the littlest and the tallest. Okay. But they just take competition, and they've done it in healthcare but anyway, I'm not going to go down there yet. But but what happens is that in that contract, the property manager is now contractually legally allowed to take a kickback from the contractor for walking them in. And the one we see the most is 10%. And what happens is contractors go out and do a bid for the insurance work. And then they are allowed by law to ask that, okay, here's what the insurance company came up with. We want 10% for overhead and 10% for profit. And what that's supposed to be is all the cost of the materials. They allow that roofing contractor, for instance, to mark the materials up 10% for a profit. The overhead is administrative costs or costs that are incurred to handle the claim, and like having a project manager or someone like that on there. Well, in this case, what it is, it's the kickback to the finder's fee to the property manager. These boards, these unit owners need to go to the boards and say, rewrite that contract, get that out of there.
Okay, so there's two items now we're talked about that they can go to the board on. One is educate them on lowering the deductible. And the second thing is
have the right to have the correct deductible. Yep.
Yeah, have the correct deductible. And then the second one is going to them and saying, let's look at how this thing is set up with contractors and project management.
So Dan, let me go through. So when you look at an HOA's deductible, there's going to be a dollar amount. Let's say 25,000.
Yep.
50,000. Okay. Then there's going to be a percentage deductible.
Hmm.
First of all, let me explain why that is. Then it'll all make sense. Insurance companies want to get out of the roof business, but the law says they have to insure the building.
Mm-hmm.
So what they do is they say, okay, we're going to go ahead and have a $25,000 deductible. But if the peril that caused the loss is wind or hail, it's going to be 10% of the total amount of coverage that you have. So again, if you have a $300,000 condo, you're going to have a $30,000 deductible with a 10%. And guess what? Now the roof's not covered. Problem solved.
Interesting.
$30,000. That's insane.
Imagine a young family, or imagine somebody, a senior on fixed income.
Exactly.
It's a kick in the stomach is what it is.
It's not right.
No.
So this is where
it's easily fixed, but you have to know about it. When we talk about that coverage A, that covers the inside of the condo, to increase that, it's for each $1,000 you increase it, it's $3 a year.
Okay.
So if you're going to go from 20,000 to 50,000, you're looking at $90 a year. It's what you do, but you got to know about it.
Yeah. Interesting. So what we were talking about as we get into these situations, because it was interesting. Beth and I were at a conference a couple of weeks ago, and it's kind of the buzz topic with agents or realtors right now about, how we dealing with this thing. And, it's funny because there are some folks that bring it up as an issue, but don't have a solution. And, it's got to be problem, you've got to be able to solve these issues.
Right.
And so as we look
all
at,
you're doing is complaining, that's a family reunion.
Yeah.
you have to bring some solutions with the problem that even if they're bad ideas, just get thinking, just bounce stuff off of people, because what Beth, is different than what I know because of all the experiences you've had until you sat in that chair. Same with me. When I was a state legislator, it was eye-opening to me how some of this works, and these laws are in place because they're picking a winner. Someone's going to do very, very well because of the way that law is written.
Yeah. Interesting. Now, I know in our previous conversations about remedy on this, you had said, we've got access on a listing, for example. There's an agent note where we can make some comments in there about the HO6 policy and, the master policy. But you would also mention about in the seller's disclosure, it might be a good place to put. Could you go into that a little bit of what your thought is on that?
Okay. So I'm in your world now.
Yep.
Okay. All right. So correct me all right. So you go through and when there's a real estate transaction that involves a condo, there are things the buyer absolutely should be aware of. Mm-hmm. Okay. And when we talked one time, Dan, you said something about, is there a checklist? I have to do that. I just got to sit down and do it. Mm-hmm. I got to take the time. But a checklist and some of the things you find out about is, well, okay, I want to look at the financials of the association. What do they have for deferred maintenance in there? You know what I found out when I was a legislator? They're required by law to have a deferred maintenance account that equals the depreciation schedule of windows, siding, roofs, and there's a bunch of them that don't do that.
Right.
And because now you're gonna the members of your association are gonna be mad at you if you're the board member that says, hey, we got to raise our association dues because we've got to supplement that account.
Mm-hmm.
So instead, what they're doing is once the roof starts getting a little low, they all go outside and start doing a hail dance and see if they can make it hail, and then just have the insurance company take care of it. Well, now it's coming back in the form of incredible premium.
Yeah. Yep. And again, if somebody didn't take care of it on the assessment coverage, then they're in trouble.
Or the HOA becomes important because now we're seeing associations saying in their governing documents where they spell out what they're responsible for and what they're not. That's what we call their insurable interest. It'll say in there that, well, the HOA isn't going to get involved in any damage to the structure that is below our deductible. So now you have that kitchen fire. Somebody comes home Friday night and they use the smoke detector as an oven timer when they're having that late night pizza. Okay. And what happens is that you have all this damage and the association doesn't get to our deductible. We have nothing to do with it. Now you're going directly to the HOA. And that's where you have to have that coverage A up there at an adequate limit also.
Okay. So there really is a timing on that. Hey, there was one other topic we had on this thing, and it was the timing of when something is assessed versus when the actual occurrence happened.
Yep.
Could you
Okay.
go into that a little bit?
I can. How that works in assessment coverage, and I'm going to slow way down for this.
Yep.
Okay. In every HO6 policy, there is assessment coverage. Insurance companies write them one way or the other. Okay. One way states, and this is what everyone assumes, we will pay for any assessment the insured incurs from an association as long as the damage was caused by a peril we insure against and the damage occurred during the policy period.
Okay.
Pretty straightforward. However, almost half the HO6 policies out there have it worded differently. It says we will pay for any assessment that the insured incurs from an association as long as the cause of the loss, the peril, is a peril we insure against, and the assessment occurred during the policy period. Now it goes by the date of the assessment letter. Well, you could have, so I'm buying your condo from you.
Yeah.
Okay?
And let's assume a close date of October 31st.
Okay. Let's do a real one. October 11th. Okay. So there was a hailstorm that went across the metro area. It was very, very small hail, but it was hail. And, you're getting ready to, sell your house, your home, you're doing all that. You got other things to worry about. It's not on your radar screen. Okay.
Yep.
And you have an HO6 policy that says we will pay for any assessment as long as you are assessed during the policy period. As long as you are assessed. Okay.
Okay.
Now I buy the unit from you. Go buy my HO6 policy, and my HO6 policy says it will pay for any assessment as long as the damage occurred during my policy period. All of a sudden, the hail damage manifests itself. Now remember, the property management company have a very vested interest. If there's an insurance claim, they want to go with it because they're gonna get a cut of it. Okay, that's why it's such a problem. So they go through, run the claim through, and now I own the condo. I turn it in, and they said, "Well, no, we're not covering it. The damage did not occur during your policy period, so you have no coverage." So then I turn around back to the seller and I said, "Hey, you sold me a damaged unit, okay?" And this is where you get with the seller's disclosure and doing inspections. Look at the roof for Pete's sake, doing inspections, and now you go back to that guy and say, "Hey, if it was all written up right, well, you got to pay for that roof." Well, that guy doesn't have coverage either. He had to be assessed during the policy period. His policy's already canceled. It's gone. So
it's stuck on the new owner. You're stuck with it, and that's where it can be significant if they don't have they don't have any coverage then. So to remedy that, again, what you need to look at.
Let me just go through again. The seller is saying that he has to be assessed during his policy period, and the buyer is saying that it has to take place during his policy.
The damage has to have occurred. Yep. The occurrence has to have happened during the policy period. Yep.
Oh.
So let's use the example you mentioned. That storm hit on October 11th. And let's say that you end up closing on October 31st. The seller sells it to the buyer on October 31st. How quickly do assessments usually happen after an occurrence?
So what would happen in that case is that, first of all, the board would get all rattled. Okay. I've been involved in many of these, and they call a meeting, a full membership meeting. Okay. And in the meeting, they say, "Hey, we had someone come and take a look at our roof. They haven't maybe not even set up a claim yet. We have somebody take a look. We have damage. Here's what our deductible is going to be, and here's what your percentage, what your assessment for that deductible is going to be. You really need to come to this meeting and bring your policy." And guess what? They all get to that one. The regular board meetings, they don't have enough people to play cards,
Interesting.
Yep. So now they come in, they walk through and they explain, "Yep, we're going to have," I was just at one the other day, "we're going to assess you $18,100. That's what it's going to be." Okay. pull out your policies, and then Lunan will walk you through where you're going to look. So I take them to the table of contents. I go look at section 1, look under supplemental coverages under section 1, and then it's going to say assessment coverage. What page is that on? Turn to that page. So they go through and they get there, and they're going to see one of the outline is going to be the assessment coverage. And then it's going to be very, very clear if it's the date of the damage or the date of the assessment. And then what they did is they said, well, we're going to send the assessment out in 14 days. If you don't have enough coverage on your HO6 or you have no coverage on your HO6, you have 2 weeks to go find an HO6 policy that does cover it. We don't want to know about it, but you get that thing in place before 14 days from now. And I think it was 27% of the people in the room didn't have enough coverage.
Wow.
And so they all went scrambling, and they all went and got different policies because the agent didn't think, this time of year didn't think to ask about, well, wait a minute, is there any hail damage on the roof? Right? I mean, they'll start asking that question now, but they aren't at this point. And so that you're literally buying the insurance after you had the claim.
After a claim. Okay.
I would not count on that.
Yeah. Is that okay? So I'm looking at, again, the example I sent you with the people that are looking at selling.
Yep.
And you looked at their policy, and I believe they're HO6. And how did you find on theirs then? What did you find on their policy versus, in this situation, for example?
I'm not going to remember a specific one. I got too many of them, but
okay.
They had adequate coverage.
Yeah.
The one you showed me.
Okay.
The numbers were all up there. It's just that, paying on the data. I think theirs did the date of the storm, the date of the damage.
Okay. So if they sell, and a storm occurred during it, they're covered. And then
nope. So great point.
Okay.
First of all, there has to be insurable interest. Okay. So I'm gonna use a different example that you'll understand.
Okay.
I buy your car from you, your SUV from you, okay? And you go, Lunan, I know you well enough. I'm gonna guess you're a lousy driver, okay? I've got 3 months left of my insurance. I won't cancel that. I'll just throw that in on the car purchase for you. Okay. They're great. Well, what happens is when I buy that car, that title gets transferred. Your policy, you no longer have an insurable interest in that car. They won't pay for me. Okay. Now in the condo, how the insurable interest is created is in that during those the listing, I don't even know what to call them, listing documents, so that your seller's disclosure, whatever. That's where you would create that responsibility that if there is an assessment, if there's found to be damage that existed prior to our closing, that's going to come back to your policy for coverage.
Great. That makes sense.
Perfect.
Yep.
Perfect.
But if you don't have that in there, and I bought your unit from you, let's face it, you didn't have any loss. You have no responsibility. And so your policy isn't going to pay anything. Yep. But if contractually you're on the hook for it, now the policy will take a look at coverage.
If we put something in there, yeah. Good. Yeah, there's a lot of nuances to this thing, isn't it?
That's a great line, though.
What's that?
That just if there is damage prior to our closing, your policy is to pay it or is to cover it.
It's going to go. It's that you are responsible for it. Yep. And there may be a sunset date on that. We're only going to go back so far. Whatever it is.
Right.
And that's where, Beth, people bring me in when they quote unquote think it's too late. And because we've done so much research, I've researched statutes and all of that. If there's somewhere where it can get covered, I'm going to find that. This dog hunts. Okay. And I'm going to come up with, well, here, consider this. You can come in this way. And I can't, it doesn't always happen. And I would never, ever rely on it. But it's brought in. What happens in contractual law, as you guys know, if a contract is not clear, so let's go back to that seller's disclosure. If it is not clear or address whatever the problem that came up is, the courts always rule against who wrote the contract. So in this case, the seller's going to get stuck with it. Just like in insurance, if a policy isn't very clear, the courts will always rule pay the claim.
And in the example you gave, if a seller does write into the disclosure, if there's any damage that occurs prior to the closing, our policy covers it.
Our policy covers it. You're responsible for it. The
seller
policy comes in and pays what that's called is compensatory damages. That seller is required to compensate the buyer for that cost that was incurred. And then it goes to the policy.
And then that makes a buyer that's coming in comfortable with the fact that, hey, if something doesn't get assessed until afterwards,
I can't get caught. Right?
What's that?
That you can't get caught. Right. You aren't gonna get booby trapped. You didn't know it.
The buyer.
I've been dying to ask a realtor this for 2 years now. During that time, when people would buy a house and waive an inspection, oh my God, my ears got hot just saying that.
Yeah.
Oh, what are you buying? How do you know what you're getting? And all of a sudden you get all these insurance issues and these things.
Oh.
It's like,
no way. We never did it.
Oh my gosh, there's a bunch of them out there.
We had listings, Bob, where it was a competitive time, and we had a listing, and people would come in and offers. It'd be multiple offers, and some of them would say, "Hey, we're waiving the inspection," and we would present to the seller, and the seller might choose one of those, not necessarily based on that, but to a person, isn't this true, Beth? That to a person, we would write in the counter offer, "We accept your offer, but you have to do an inspection." And it was almost counterintuitive to these people. And then you could just feel a sense of relief on the buyer. It's like, okay, good. They chose my offer. And now I get to do, it's like, I think it's landmines all over the place. Oh. And we're not, our broker, we talked to them about it and they said, yeah, lawsuits are happening.
Well,
it's
we're
like,
seeing them.
Yeah.
Well, and you can also, string it out the timeline for the closing. And now the seller they've got commitments in place for where they're going to.
Yeah.
You wait until they're committed somewhere else and just say, hey, my bank won't give me the money unless they do an inspection. And now the seller's like, well, I have to have this deal go through.
Yeah.
Now they come to the table.
Yeah. Yeah.
But I don't understand why. Well, there was a lot of cash deals. I don't understand why the banks weren't saying that they wanted an inspection. They now are in charge of this asset. I don't understand that.
Yeah.
It was there. It was out there.
It's kind of like what you were talking before, Bob, about how it's like this insurance issue now. This is now something that you have to have the headlights on. You have to be paying attention. Whereas in the past, I have a feeling banks were they had their checklist, which did not include how did the inspection look.
Yeah.
They wanted to know if you were through the inspection, and then they order the appraisal. And this is a new item on their checklist.
Well, and I think what's coming, this is just my opinion, but you are both entitled to my opinion. What happens is that I think the replacement cost on roofs is going away. I think you have a 20-year shingle and it is 15 years old. All your loss is those last 5 years of life expectancy. That's your claim.
Yep.
You're paying for the betterment.
I can see that.
And I absolutely agree with that. We are now, and I could tell you a whole story of when this all flipped in 1998, May 15th and June 1st, and how everyone's expectation changed, and they realized, oh my gosh, I can use my insurance policy as a maintenance agreement. And what people found out is that, oh my God, if I get a stain on my carpeting, my homeowner replaces my carpeting. Yeah. And that's when you saw these rate increases go on, and it was designed to push people up to bigger deductibles so they would quit doing that. And I have a joke I tell that, I got stain. I want to sell my house, but I got a stain in the living room. And so what I do is I invite my grandkids over with their friends, and I line up all the Dixie cups on the counter, and I fill it with red Kool-Aid. I said, everybody grab a cup. We're going to go in the living room and play tag. And wear and tear isn't covered, but a stain is.
Oh, okay? Gosh.
And then people are doing that, just using it as a maintenance agreement.
Hey, that 1998, isn't that when some big hailstorms came through the area?
Yep. So May 15th, there was 100-year storm. It came right during rush hour traffic.
You remember that, Beth?
Mm-hmm. Yep. And what happened was it was a 100-year storm. We're never going to see a storm like this again. And the insurance industry had that same data and just said, well, only 7% of our insureds ever have a claim. 93% of the people that are going to have claims have never used their insurance before. We're going to show them what they bought. Complete unintended consequence. Because what it is, they educated those people about, oh yeah, I just wait it out and have a storm damage or some kind of damage, and then turn your item in, and now it's covered. And it just changed the whole paradigm. Well, then June 1st, we had another storm. So we had 200-year storms 2 weeks apart. So you think we'd be good for a while.
Mm-hmm. Well, it's in the same year.
What's that?
It was in the same
almost
year.
in the same month. And what happened is that year in Minnesota, on the average, for every dollar an insurance company took in premium, they paid out $1.74 in claims. Oh. And you still had to have your operating expense, so it got it over $2. So it was a two. Well, you aren't going to do that very long.
No,
No, you're done. That's what's going on right now. Is that and I mean, I'm not going to. We don't have. I don't know how much time we got, but anyway, the insurance companies right now had to dip into the reserve for all of these storms. We had a higher frequency or likelihood of claims occurring, and then you match that with the fact that we overpaid claims. Plain overpaid them. And the insurance company, they're agnostic to it. They just pass it on in premium, just like in healthcare. Consumers are the ones buying it. And I use the example, and I think I've used this with you, Dan. There's two types of weddings, and it's not Catholic and Lutheran. It's open bar and cash bar. And you drink different at those weddings, okay? And they did a study that said, and it was actually the one I saw was from Harvard, that when there's an open bar wedding, almost 10% more alcohol is drank. Now, I get kind of quiet with that stat because I'm like, I know which way I'm pulling that, okay? But then it said that there's like 34% more alcohol sold. And I thought, I was always trying to figure out what that was. Well, then I had one of my sons got married, and so we're having the reception downtown St. Paul, doing all that stuff. Well, then all of a sudden it's over. And on come the lights. And for the first time ever, I noticed all the wait staff comes blowing out of the kitchen. And they all got 5-gallon pails. And then like 4 of them have carts. And these waiters were grabbing the glasses, dumping the half drinks in the buckets, and setting the glasses at the end of the table. The guys with the cart were taking the glasses away. And I looked at all those 5-gallon pails of booze that no one was going to get to drink. And it all got paid for. Yeah. And I know because I'm the one that paid for it. Okay.
Interesting.
But it was just like there. Now I see how, and I, people acting different because they have insurance. That's not people being bad. That's people being people.
Yeah.
That's right.
Yeah, very good point.
I can tell you right now, I eat different at a buffet. I can't believe I don't have the word fork on my resume. It's for $10. Anything I push into the front of my head, I get. Well, that's free.
Yeah, basically.
It's the same thing with an insurance claim, but nothing is free.
Yeah,
nothing
exactly. Well, this is an interesting.
The professionals, the realtors, the insurance agents can add so much value, but you do have to step forward and offer it, even if the customer doesn't buy from you. My product is not the commodity of coverage. My product is the information an insured needs to make an informed insurance decision. Yeah, that's my product.
Excellent.
If I can use an example or an analogy that's simplified down enough that my insured understands it, I know my insured socialize with people just like them. And the story I'm going to use is going to be someone just like them. Well, now in a social setting, they're going to go, hey, yeah, this insurance guy told me, blah, 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 and there it goes. And now they get it. Okay. And that's what I want, is to get that information out there.
Yep.
So when people are looking at the HOA docs, there's the articles, the bylaws, and the covenants.
Yep.
What are they going to look at?
Bylaws.
The bylaws. Okay.
Bylaws are the rule of governance. And we have in fact, we're going to have one of our real estate continuing ed classes is going to be how to read HOA documents.
That's really critical.
Can I take it?
Let me give you a little tip here. And I learned this from reviewing contracts. And then once I became a legislator and I had to review statutes, you get those governing documents as a PDF. Up towards the top of it, click your mouse and get the mouse on it. Then you hold down the control key and the F for find. It's going to open up a window and you search the word assess, assessment, insurance, one at a time. It'll take you everywhere in the documents where they are. And now all you're learning is what you need to know. You aren't learning all the other stuff.
Yeah.
Okay.
Excellent. Very good. Very good.
Beautiful.
Cool. Okay. So just on this particular topic with these multifamily unit condos, there's a couple items that it sounds like from a realtor standpoint, we need to work in concert much more with insurance agents just to make sure policy coverage is adequate. We need to be looking at adding something really in the seller's disclosure that just really covers our sellers and also for buyers just to know what's in there and who's covered. And then with the HOA, the actual board is to help educate them on the importance of looking at get the deductible in a correct manner, maybe down to 5% or whatever it is that from a lending institutions will cover. And then also helping educate lenders or underwriters as to what the HO6 is going to cover as far as any difference.
And I think there's a way you can do that, Dan, that it doesn't, people won't get defensive. I've seen many times where someone on the board knew that their feet weren't touching the bottom of the pool. And so they would get very defensive if they were asked a question.
Yep.
And instead, what you do is you give them a little breather and saying, okay, so I've got my client here looking at buying a unit in here. Here's some of the questions that they're asking me. Would you mind going and finding out what the good data is on it? But isn't right in their face. And you're going to have a couple that are so not legitimate that they won't do it. But the vast majority of them will go, I'll get that for you. And guess who else they're going to give that information to? All the members, because now they just learned something.
Yeah, interesting. Good. So the big education piece going here.
Yep.
Excellent. That's really helpful. And I know this is going to be a big topic going forward.
Yep.
Beth, any other questions you had?
Yeah, back to the contractors. When you have somebody choosing a contractor to work on the condo, what hiring process would you think would be the best way to do it?
Well,
I know it's simple, but you had some clear opinions.
Boy, you just hit me a lob right here. First of all, there is no reason to sign a contract with a contractor till you absolutely want them. And I don't mean you like them. I don't mean you'll have a beer with them. I mean, this is who I trust. You get a whole sense of trust. Okay. Before that contract that you sign only benefits the contractor. It does absolutely no good and is a detriment to the owners. Okay. Once you sign that contract, you have 72 hours to get out of it. That's ridiculous. Okay. And what happens is that if you don't get out of it and you don't want to use that contractor, because all of a sudden now you kind of figure out they're just salespeople. They go out and they rack you up. Now they'll get to your roof when they have time. They're going to keep selling.
Right.
Okay.
Right.
Well, now what happens is you decide to go use another roofer. In their contracts that they sign, we have this class coming up too. You have to pay them 25% of the bid, the job, or 50% of the bid in cash. And then they don't do the work. And I've seen regularly, I see those.
Yeah, I do too.
Yep. And it's just that contract's ridiculous. And in fact, if somebody told me I had to sign a contract, you need to leave. Get off my planet. I don't need that. If you're legit, you don't need that contract.
So any contractor that's pushing for signatures, beware.
That's a salesperson. And what happens is they get paid a big commission for anybody they ink. Don't let anybody on your roof unless they've demonstrated to you in writing they have insurance. Because if that sales rep goes up there on the roof and they're an independent contractor, so they don't have any work comp coverage and they get hurt, that's going to go to the homeowner. They're responsible for all the benefits that are paid out to that injured person.
Okay.
So boards need to be more responsible too.
Yeah, and just getting references too.
So what are some of the other things you're doing so we make sure we get your information out? Could you give us your phone number, some of that, just to tell us a little bit more of what you're doing and how you're teaching all these details, which are great.
So the website, all of our contact information is on our website, Lunan and Lunan.
Consulting.
A realtor, banker, I've got all of that. Okay. And then the best email address is actually mine, rlunan
@gmail.com.
Perfect.
And my personal cell phone number is 612-298 5337. And I got 4 calls during this little presentation, by the way. And those
Wow.
ended up being people going, hey,
They're ready to go.
What's going on? Yeah.
days.
Yeah. Robert, thank you as always.
Yes, thank you. And make sure that they stay in touch with you for being educated. Also, for any kind of policies they need, and that they would use us for real estate, because that's also what we do. So we're realtors with the Flamingo Group. That's
Tell people what they want to hear. I will always tell them what they need to know.
Yep. Perfect. Good. Thank you, Robert.
Thank you for your time. Great information. Love it.